The Fed just reset the stock market, not adjusted it, not tweaked it, reset it. And if you don't understand what just happened, you are going to make decisions with your money over the next 6 months that you will regret for years. Here's what I mean. For the last year, almost everyone on Wall Street was playing the same game. They were betting that interest rates were going down, cheaper money, higher stock prices, easy trade. That was the whole story. Then a few weeks ago, the Fed did something quiet, something most people scrolled right past, and it flipped that entire story upside down. They didn't just hold rates steady. They erased the language that told markets a cut was coming. They replaced it with a warning that the next move could be a hike. That is not a small technical detail. That is the machine changing direction. And when the machine changes direction, the people who see it early protect themselves and even profit from it, and the people who don't see it get run over. I've watched this exact pattern play out 5 separate times in my life. It always looks confusing at the moment. It is actually very simple once you understand the mechanics. So let me walk you through exactly what happened, why it matters more than the headlines are telling you, and what I would be doing with my own money right now if I were you. Before I go further, I want to say something directly. What I'm about to explain to you is the same framework I've used to navigate 5 different Fed regime changes across my career. And understanding it has been worth far more than thousands of dollars to the people who've grasped it early. I'm not going to charge you for it. All I ask is that you hit subscribe right now before you keep watching, because I'm going to be tracking this situation closely in the weeks ahead, and you don't want to miss the next piece of this. It costs you nothing. It could save you a great deal. Go ahead, tap it now, and let's get into it. So here's what actually happened in plain language, because I think the news coverage made this sound more complicated than it needs to be. In mid-June, the Federal Reserve held its regular meeting, and for the first time under its new chairman, Kevin Warsh, the committee made a decision that changed the tone of everything. They kept the interest rate exactly where it was, between 3.5% and 3.75%. On the surface, that sounds like nothing changed. Same number as before, nothing to see here. But underneath, everything changed. And this is a lesson I've learned over and over again. In markets, the headline number is rarely the story. The story is in the details underneath it. In the previous statements, there had been language suggesting the Fed was leaning toward cutting rates. Later this year, that language disappeared completely, just gone. In its place came a warning that inflation was running hotter than expected and that a rate increase was now genuinely on the table, not as a remote possibility, but as a real scenario the committee is preparing for. Their own internal projections, the ones they publish a few times a year, showing where each official thinks rates are headed, shifted in a way that hadn't happened in a long time. The median expectation moved higher, not lower. A few months ago, those same projections had at least one rate cut penciled in for this year. Now that cut is gone from the picture entirely, and some officials are penciling in a hike instead. Inflation expectations for this year got pushed up to 3.6%, well above their 2% target. And core inflation, which strips out food and energy, also moved higher to around 3.3%. Think about what that means in practical terms. 6 months ago, the entire market, every trader, every fund manager, every algorithm was pricing in cheaper money ahead. That assumption was baked into stock prices, bond prices, real estate financing, all of it. Now that same market has to price in the possibility of more expensive money ahead. Instead, that is not a minor adjustment. That is the ground shifting under every single valuation on the stock market, whether individual investors realize it yet or not. And here's the part most people miss because they're not paying close attention to how these things are communicated. The new chairman made a point of removing the traditional forecast the Fed usually gives about where he personally sees rates heading, saying flat out it wasn't helpful for conducting policy. He also said there would likely be a broader review of how the Fed communicates going forward. Transcripts, meetings, the whole approach, that itself is a signal. And I want you to sit with this for a second. When a new leader walks into an institution and changes not just the policy, but the entire framework for how the policy gets communicated to the public, it tells you he is not simply continuing the old playbook with a slightly different accent. He is resetting expectations on purpose, deliberately, as a first move. That is not an accident. That is a decision. And decisions like that tend to set the tone for everything that follows. Now let me explain why I call this a reset and not just a policy tweak. Because this is where most explanations you'll see online get lazy. They'll tell you rates matter because borrowing gets more expensive for companies and consumers. That's true, but it's surface level. And if that's all you understand, you're missing the part that actually moves stock prices the most. Here is the deeper mechanic. Every stock you own is at its core a claim on a stream of future cash. When you buy a share of a company, you are not really buying what it's worth today. You are buying what people believe it will earn for the next 10, 20, 30 years. And then that entire stream of future profit gets translated into a single number in today's dollars using something called the discount rate. This is basic finance, but almost nobody thinks about it when they're actually buying a stock, and that's exactly the mistake. The discount rate is heavily influenced by where interest rates sit today, and more importantly, where people expect them to go over time when rates are low and expected to fall further. Future earnings get discounted very lightly. $1 of profit 10 years from now feels almost as valuable in today's terms as $1 sitting in your hand right now. That is why cheap money inflates stock prices, and it inflates them unevenly. It inflates them most for companies whose profits are mostly expected far off in the future. The fast-growing tech names, the story stocks, the businesses that aren't very profitable yet but promise to be enormously profitable someday. Those are the stocks that benefit the most from low discount rates because so much of their value sits many years out on the timeline. Now flip the switch. When rates are expected to rise, that same future dollar gets discounted much more heavily. It is worth meaningfully less in today's terms. So the exact same company with the exact same business, the exact same customers, the exact same product, the exact same growth trajectory is suddenly worth less on paper purely because the math behind its valuation changed. Underneath it, nothing about the actual business changed. This is the part people don't feel intuitively because it seems unfair, it seems disconnected from reality, but the price has to adjust anyway because the price was never really a reflection of the company in isolation. It was always a reflection of the company plus the environment that exists in, the interest rate environment specifically, and that environment just shifted under everyone's feet in June, whether the news made it feel that dramatic or not. That is why I call the FOMC's June decision a reset rather than a routine meeting. It didn't just adjust one small input somewhere in a spreadsheet. It reset the entire discount rate assumption that the whole market had been quietly building into every valuation for the better part of a year. Every analyst spreadsheet, every fund's internal model, every price target that assumed rate cuts were coming later this year now has to be recalculated from scratch. That recalculation does not happen instantly. It takes time to fully show up in prices, sector by sector, stock by stock, as new information arrives and forces people to update their models. And that lag, that gap between when the underlying assumption changes and when prices fully catch up to it, is exactly where both the opportunity and the danger live for anyone paying attention right now. Let me put this in historical context because I've lived through versions of this before, and the pattern rhymes even when the specific numbers and the specific names are different. Go back to the late 1970s and early 1980s. Inflation had become entrenched in the economy, embedded in people's expectations, in wage negotiations, in the way businesses set prices. The Fed, under Paul Volcker, made a hard pivot, prioritizing price stability over short-term growth, even though it meant real economic pain. Interest rates shot up dramatically to levels that would seem almost unimaginable today. Stocks struggled badly through that transition. It was a genuinely difficult period for investors who didn't understand what was happening. But the people who did understand it, who recognized that the old assumptions about cheap, easy money no longer applied, who positioned defensively during the transition and then repositioned once the new equilibrium became clear, did far better than the people who kept stubbornly assuming the old easy money world would simply snap back to normal. Fast forward to 2022, a period a lot of you watching this lived through directly. Inflation surged again after years of near zero interest rates following the pandemic, and the Fed had to reverse course sharply and quickly, raising rates at one of the fastest paces in modern history. Growth stocks, the ones most sensitive to that discount rate math I just walked you through, fell the hardest. Some of the most popular names losing 50, 60, even 70% of their value from the highs. Meanwhile, value stocks, companies with real current cash flow rather than distant promised profits, companies actually making money today rather than someday, held up meaningfully better through that same period. That difference in outcome is not a coincidence, and it's not random. That is the exact mechanism I just described, working precisely the way it always works. Now here we are again, in a new version of the same underlying pattern. A new Fed chairman stepping in, a hawkish pivot in tone and policy, inflation running above target, made worse by real supply shocks this time, tied specifically to energy prices and the conflict in the Middle East, pushing costs higher. And layered on top of that, weak jobs numbers coming in alongside sticky, stubborn inflation, which happens to be the single most uncomfortable combination for any central bank to navigate. Normally, weak jobs data would argue clearly for cutting rates to support the economy. Normally, high inflation would argue clearly for raising rates to cool things down. Right now, you have both signals pulling in completely opposite directions at the exact same time. And that tension is precisely why the market feels confused, why volatility has been picking up in recent weeks, and why so many individual investors are genuinely unsure what to do next. I want to be very clear about something here because I don't want you walking away with the wrong takeaway. I am not telling you this is 1980 all over again. And I'm not telling you this is exactly 2022 repeating itself. Every single cycle has its own specific character, its own specific triggers, its own specific timeline. But the underlying machine, the relationship between interest rate expectations and how assets get priced, that part does not change from cycle to cycle. It has operated the same way for as long as modern financial markets have existed, through booms, through busts, through wars, through pandemics, and it will keep operating that same way long after this particular episode has faded from the headlines. So what should you actually be thinking about doing with this information? First, understand that this is not a moment for panic, and it's not a moment for blind confidence either. It's a moment for clear thinking. And clear thinking is honestly the hardest thing to hold on to when markets get uncertain because emotion tends to take over right when you need logic the most. The biggest mistake I see people make in a moment like this is assuming the recent past will simply continue indefinitely, that the easy money environment of the last few years is the permanent state of the world, and this is just a temporary blip that will pass. It isn't a blip. Regimes change. The economic machine moves in cycles, sometimes gradually and sometimes in these sharper turning points. And right now we are watching one of those turning points happen in real time, right in front of us. The second biggest mistake is the exact opposite, assuming everything is about to collapse and running entirely to cash purely out of fear. Fear-driven decisions are usually just as costly as complacent ones, sometimes more costly, because you end up locking in losses on the way down and then missing the recovery entirely once the new equilibrium establishes itself and prices stabilize. I've seen both mistakes destroy portfolios. And honestly, I've made versions of both mistakes myself earlier in my career before I learned to build a better process around it. What I've found actually works across every single cycle I've navigated over the decades is thinking in terms of balance rather than prediction. Nobody, including me, can tell you with certainty whether the Fed hikes in July or holds steady again at that meeting. The data genuinely is mixed right now. Weak job growth pulling policy one direction, sticky inflation pulling it the other direction, and reasonable, experienced people disagree about which force wins out. What you can actually do, regardless of which way it breaks, is build a portfolio that doesn't depend entirely on you guessing correctly. That means understanding which parts of your portfolio are most sensitive to the discount rate mechanic. I walked you through earlier the longer duration growth names, the companies priced heavily on distant future profits rather than current earnings, and recognizing honestly that those are the pieces most exposed to further repricing if rate expectations keep drifting in a hawkish direction. It means understanding that companies with real current cash flow, reasonable valuations relative to their earnings, and genuine pricing power in an inflationary environment tend to hold up meaningfully better through this kind of transition because their value depends less on distant promises and more on what they're actually generating right now. It means having genuine diversification. And I mean that in the real sense, not just owning 20 different stocks that all move together, but owning assets that actually respond differently to this exact scenario, because history shows clearly that no single asset class performs well in every single environment. And it means paying close attention to the same data the Fed itself is watching, the monthly inflation prints, the jobs numbers, because those specific inputs are what will determine which direction this reset ultimately goes over the coming months. And you want to be watching the same signals the people setting policy are watching in real time, not reacting 3 weeks late to a price move that has already happened by the time you notice it. I also want to be honest with you about something, because I think honesty matters more than confidence in moments like this. Nobody can tell you the exact day the next move happens or the exact percentage your specific portfolio will be affected by it, or exactly how deep any pullback goes before it stabilizes. Anyone promising you that kind of precise certainty is selling you something, not informing you, and you should be skeptical of them. What I can tell you with real confidence, because I've watched this exact mechanism play out repeatedly across 5 decades of paying close attention to markets, is that the direction of interest rate expectations is one of the most powerful forces acting on asset prices in any given period of time, more powerful than almost any single company's earnings report, more powerful than most individual news events. And right now, that direction has genuinely shifted. Whether the shift feels dramatic on any given day or not, the companies and the investors who understand that mechanism, who adjust their thinking rather than just reacting emotionally to headlines, are the ones who consistently come out the other side of these transitions in a stronger position. The ones who ignore it, who assume nothing has really changed because the headline interest rate number itself didn't move in June, are the ones who get caught flat-footed later when the next piece of economic data confirms the new direction, and that the market repricing accelerates all at once instead of gradually. That's usually how it happens. By the way, not a slow, orderly adjustment, but a long period where not much seems to happen, followed by a sharp, fast repricing once enough confirming evidence piles up. That's when the people who weren't paying attention get hurt the most, because they're forced to react under pressure instead of having already positioned themselves calmly ahead of time. This is not about predicting the future perfectly. Nobody can do that. And I say that as someone who has spent his entire career studying markets. It's about understanding the machine well enough that when it shifts, you're already prepared for either direction, instead of finding out the hard way 3 or 4 months from now that you were positioned for a world that had already quietly stopped existing. Here is my challenge to you. Don't just watch this video, nod along, and move straight on to the next one in your feed. That's the easy thing to do, and it's exactly why most people never actually change how they think about their money. This week, actually go look at your own portfolio, line by line if you have to, and ask yourself honestly which parts of it are built on the assumption that interest rates are going to keep falling from here. Be honest with yourself about that, because most people, without ever consciously deciding to position themselves for a world that just quietly stopped existing back in June. That's not a criticism. It happens to almost everyone, because most of us build our assumptions based on the recent past without realizing we're doing it. You don't need to make dramatic, sweeping changes overnight. And I want to be clear, you should always think carefully and ideally talk with someone qualified who knows your full financial picture before you do anything significant with real money. I'm walking you through a framework here, not handing you a specific instruction for your specific situation, but you do need to update your thinking because the environment has genuinely and meaningfully changed, whether you've fully acknowledged it yet or not, and the cost of staying anchored to old assumptions in a new regime is one of the most expensive mistakes an investor can make. I'll be tracking exactly how this plays out over the coming weeks, especially heading into the Fed's next meeting on July 28th and 29th, and I'll break down what the incoming data is telling us as it arrives piece by piece, so you're not left guessing. If that's useful to you, make sure you're subscribed right now so you don't miss the next update. Drop a comment telling me what you're actually seeing in your own portfolio this week, and I'll see you in the next one.